Good evening, everyone, and a real pleasure to be back in Malaysia. And I promise I won't spoil your appetite, in part because our favorite market, the US equity market, is at record highs. And we'll talk a lot about that. Obviously, China is not doing so well as an equity market. We'll talk about that as well. So it is a complex world, which we'll try to navigate you through it, starting with a disclaimer. But a complex world. But the issue is that we try to have a core case and we try to focus on fundamentals, because if you stare too much at all of the risks, and especially at geopolitics, you will remain out of the market. You will sit on cash. And that is, quite a disadvantage, especially if you look at, what happened in 2023. I talked to a lot of investors, and especially over the last few weeks, we've done a lot of that together with James. And the number one question we still get is, why should I invest my cash? If I can get 5.5% in US dollar terms here, of course, a little bit less in Malaysia. But actually, we got that same question last year as well. And look at what happened, to the markets in 2023. This is from a US dollar perspective. If you wanted to do it in Malaysian ringgit, add about 4% to all of those numbers, because, of course, your currency weakens a little bit. So holding dollars was a good idea. Apart from Chinese stocks, which I already mentioned, and oil, everything was in positive territory. And most of the asset classes, most importantly, were well above cash. The US equity market, our favorite one, did very well. US investment grade, so high quality bonds, did quite well too. US equities obviously were quite, significantly supported by what happened in technology. A lot of the technology stocks did very well. AI was, very much in the focus. I think it will continue to be in the focus. We will talk about this. But of course, if you missed that trend, then you missed a lot of the upside in the US market. Now, some people will, be a little bit taken aback by this, because actually in 2023, you had a year where the Federal Reserve and other central banks were hiking interest rates very quickly, and at the same time, the economy was slowing. Two things which should be negative for markets, and nevertheless, the market went up. Obviously, because the market is looking forward, to what is going to happen this year. We think 2024 will be better in terms of fundamentals than 23. You're no longer seeing interest rate hikes. In fact, we will see interest rate cuts, and we will talk about the economic outlook as well. So, yes, the economy is going to slow, but I can put your minds at ease. We are not going to go into a recession. If you look at all of those numbers, they are positive. So by definition, no recession in our view. All of those numbers are a little bit better than if you were to look at competitor research, which I don't recommend. The numbers are positive. You also see the US in particular, 1.7%. Why do I look at the US first? Because the US equity market, is such a big part of global, equity market. So therefore, that sets the tone for a lot of the returns, of global equities. What's important as well, those are, yearly numbers. If you were to look at them from a quarterly perspective, you would see that you basically are almost at the bottom, at the lowest point in the first quarter of this year, and that we are going to get a reacceleration of economic activity in the US, but even in Europe as well, even though the numbers there are a little bit lower. So that positive momentum should also translate into positive momentum of equity markets. When you go to, the Asian outlook, and James will talk a lot more about this, but even in China, we think the consensus is a little bit too pessimistic. You still have 4.9% growth. The Chinese government tries to get to about 5%. We think stimulus will help, the Chinese economy to find a floor. But nevertheless, no sharp acceleration. What helps Asia, though, is that you have a number of different motors. It's not just China. You have India, where we are very optimistic, not just on the economy, but on investments as well, both from a cyclical short term, but also from a longer term structural perspective. And therefore, Asia ex-Japan as a whole, 4.5%, very respectable. And actually on Malaysia as well, we're quite, positive. Now, what helps as well is, your second big fundamental is that your interest rates are going to start to be cut. Sorry, not in Malaysia, but we are going to have interest rate cuts in the rest of the world, by, again, the Fed, the US Central Bank, again, setting the tone. A lot of the financial markets, are denominated in US dollar, and therefore that, is very important. So you are going to see 3 interest rate cuts by the Federal Reserve, by the ECB, and by the Bank of England, maybe only just 2. But that obviously tends to be positive both for bond markets and equity markets. So both from a growth perspective and from a rate perspective, we have 2 elements that can support markets. Now, those who still want to be negative are going to say, well, we've already rallied so much last year in November and December. Can we continue? Haven't we had the rally? And I say no to that, because what you see what you've seen is very typical. The market does not wait until the first rate cut before it starts to rally. And what we've done here is we've gone back to all of the different cycles of rate cuts since the 80s. And I represent the 0 point is the first rate cut. We think the first rate cut will happen this time around in June. Typically what you get is that blue line for US stocks and the red line for US treasuries, government bonds. And you see here that it is very typical for the market to start to rally 7-8 months before the Fed starts to cut interest rates. So if you work back, if it's June indeed that you're going to start to have the first interest rate cut, 7-8 months before that, very normal that you started to have a rally in November or December. Actually, what this graph tells you as well is most of the rally happens before the first interest rate cut, not after it. So again, don't wait. You want to anticipate and you want to be in the market well before that first rate cut. I also want to be in the market and I want to buy before other people buy. It's always a good idea. And look at this. You as American citizens are sitting on a huge amount of cash. And if they decide to put the cash to work, it will move markets. They're sitting on 18 trillion. Now, to put it into context, 18 trillion is more than 2 times the size of the Federal Reserve balance sheet. So if cash rates start to decline and therefore they don't want to hold it anymore and they want to put it into the market, or they start to be more optimistic because, as I've said at the very beginning, they realize that you're not going to go in a recession, they put it into the market rallies further. So that's why we're optimistic, both because of that flow argument, but also because of the fundamentals. Now, where do you want to put your money? Our first conviction is to put the cash into the bond markets. In part because you cannot lock in your cash rate. If cash rates goes down, that's what it is. But if you buy a bond, you can fix your interest rate that you're going to get until maturity. Now, we are going into high-quality bonds because the growth picture that I showed, even though we're not going into recession, it is a lower growth picture than normal. And so therefore, you want to buy bonds of companies that have enough cash flow to pay their coupons. And guess what? If you look at the bond market, actually, that's also from a risk-return perspective, also the area of the bond market that is the best compensator. So you see different lines here. IG is investment grade, good quality bonds. High yield is junk, sometimes it's called. It's lower quality. Obviously, they need to pay a higher yield. Then you have emerging market government bonds and so on. So you see the relationship, and the lines that are higher are obviously the ones of lower quality. Now, typically what you would get is if you get a sell-off, you wouldn't get a parallel move. The ones that are of lower quality, they should go up much more in terms of the yield that they need to pay. That has not been the case. So you don't really give up much yield if you stick to the high quality, and that's why we're focusing on high quality bond. We're happy with 5 to 7 years duration in those high quality bonds, because again, you don't want to be too short. You want to lock in for about 5 to 7 years. So that's our first conviction and where we want to put our cash to work. So bonds is number one. Equity markets, I talked about the US equity markets, and of course, again, we've hit those record highs. And we're often asked, aren't US equities expensive? And that's because people typically, when they think of the US equities, they think about those 7 technology stocks that they can get excited about. And it's natural. But I want to show to you that there is life beyond technology, that there are other sectors as well that are exciting and that are obviously cheaper as well, and that the US equity market as a whole is not expensive. And maybe this is what people meant when they said, like, there's going to be a lot of numbers. But, I'm going to try to do an exercise here. So this is the price earnings ratio. So the price to a large extent that you pay for the earnings, that you get, or the valuation multiples. And this is the S&P 500, which is the number one benchmark for US stocks. And you see indeed that valuations have gone up over the last number of years, and it's a little bit more expensive than, historically. Not exactly the peak, but, somewhat expensive. So I can get along with that. But that's, of course, because those 7 big technology companies have a huge weight in that, and they have driven up those valuations. So if I want to correct for that, I can construct what they call an equally weighted S&P index. So where I give every stock in every 500 of the 500 stocks, I give them the same weight. And look at what happens to my line. Basically, the red line, I'm around the historical average. So US stocks, the random US stock between those 500 randomly chosen is not expensive. It's basically around the historical average. I can also compare it what happens in the bond market, because those of you who remember your finance courses, your bond yield goes into the valuation framework of your equity market. So again, a good fit, I think, between the red and the green line. So to me, it basically means, bottom line, if you want to just remember of what this shows, it tells you that the US equity market is not expensive once you make abstraction of those technology stocks. And I'm happy to look beyond technology, because the US economic resilience is also supporting earnings growth that also extends beyond technology in a lot of the sectors. And we'll talk a little bit about ideas beyond technology. You see here the earnings growth, an upward sloping line, good earnings momentum. And again, the consensus as well is looking for in 2024 for positive earnings growth in the US that is much better than what we're seeing in Europe. So we have a clear preference for US stocks over Europe. But let me give you 3 ideas of where, more specifically, what we like in the US. So AI is something that has driven a lot of the upside in 2023, but we think it will continue. And so, one of the statistics here is that 90% of the data was generated over the last 2 years. This is not just since 2010. This is since the Egyptians. All of the data that has been created since all of those, thousands of years, it's just a very exponential function. Now, why am I talking about this? Because if there's such a data overload, but a lot of it is not very useful, but some of it is going to be very, very useful for companies to raise their productivity, to invent new things. But we need help. I don't know how many of you have problems with reading all of your emails. I always tell my boss I can't read all my emails. But there is a huge amount of data. If I want to put it to work, I need AI to put it, to analyze it. And AI obviously is very good at recognizing patterns. So this is a trend that is unstoppable. This will need, therefore, a lot of investment in new chips, in software, etc., to make the best use of that data. Now, that's just not only going to help technology companies, but also going to help industrials. So our second idea is American industrials. And why? To a large extent because the Biden administration wanted to bring manufacturing back. They also want to bring chip production back to the US. And therefore, you see that huge investment in infrastructure around this in the manufacturing sector. So a lot of job creation there and a lot of new productivity gains in that sector. And the third idea, also actually to some extent supported by AI, is healthcare. It has a bit which is, the AI bit here is that AI can help you develop new drugs more quickly. If you do all of your tests, you can look again at the patterns of which drugs work and which ones don't. But also, for example, in diagnostics, it can help doctors make the better diagnosis. We also obviously all realized during COVID that our health is very precious, and therefore we are happy to invest in it more, spend more on it, and also governments are doing this as well. So healthcare, industrials, and then around technology are three of the sectors that we really like in the US. Another thematic which is close to our heart and which is very important is the net zero transition. Now, some of the investments there last year did not do very well, but this was really because of the interest rate movements and because of their growth style features. If you want to now, obviously looking at 2024, the interest rate headwind, as I said already, is going to become a tailwind because we are going to have interest rate cuts. What's more important is that we have structural support for this. If we want to get to net zero, we will need to invest 6.7 trillion every year till 2050. Now, a little bit tongue-in-cheek, but if you need to spend 6.7 trillion, if that was an economy, it would be the third largest economy in the world. So a huge amount of investment that obviously, investors will need to help fund, but also, that is being supported by 200 governments, by regulators, by, a lot of cities that want to support that as well. Obviously going to generate a lot of demand for infrastructure. So that's a sector that we like as well. And is going to go into things like electric vehicles, but also then clean energy production. And once you have clean electricity production, you need to transport it. So there's going to have to be huge investment into the grid as well. So this is really a trend that is here to stay, and therefore, very much part of our investment process as well. Now, I've given you 3 positive messages. The fourth one is a question that we get as to how you deal with volatility. And we're not saying that there won't be volatility. We are actually fully expecting that we will have some volatility in 2024. But we use that volatility to enter markets, given that our view for the year as a whole is so positive. But of course, we need to manage it. Now, let me just, and in terms of the risks, clearly geopolitics is an important one. Now, I'm often asked about the American elections, and of course, we don't particularly know exactly what the outcome is going to be. We did a poll with some of our clients in different cities over the last few weeks, and Donald Trump came up top by a very large margin. But that's a client poll. A lot still happening between now and November. What we do know is that's going to be on entertaining television, of course, but also that a couple of things will probably not change. It may be that we are in a situation where the president doesn't have control of the Congress again, and that then limits their ability to change legislation. We're also still going to be in a situation where the US-China relationship, for example, is going to be a difficult one, and James may talk about that later on. I would focus on the fundamentals because clearly we're still, quite far away into between now and November. Typically, the fourth year of a presidency, as you can see here, is a decent one. You start with a little bit of volatility around the primaries, as we're having now. Then you have a period where nothing happens, where people, just wait for the elections to come closer. Around September, October, you could see some volatility again ahead of that November election. And then typically after the election, you get a rally as well. So in our core case, you get this, as well. But we would very much focus on those fundamentals, which are, a positive for markets. Asian elections as well. But again, the question is how much this will really change the fundamentals. We've already had the first one, Taiwan, where the results were in line with the polls. Indonesia as well, probably looking for continuity, at least in terms of the program, in terms of the main points. And then around South Korea and India, obviously the largest democracy in the world. Question is what is going to happen there. Again, the polls, signal continuity. So if those things generate some, short-term volatility, some short-term interest and so on, but don't really change the fundamentals we invest in on the basis of those positive fundamentals. How would we manage that volatility? Well, through diversification, having both bonds and equities in the portfolio. Obviously also by focusing on quality assets. In bonds, that means investment grade, high quality bonds, and in equities, that means companies, with a strong margin and earnings power. Now, I'm here on Asia, so I think it's the ideal time to hand over to James, who is going to dig more into the Asian investment outlook.